All right, so this is an update on our medical properties trust position. We entered this position back in August of 2021, so it's one of our longest holding um, stocks here. I don't know why this chart is moving. Um, and anyway, we are currently down more than I believe 40 or 50% right now on the position. Anytime the position is below 10%, I always do an analysis to find out whether or not we ought to stay in the name. Now, over the course of that 3 years, we've been up and down. I have recorded some analyses on the YouTube channel. Some of them, of course, I have not recorded. Um, but this one I would definitely wanted to do because we are in the process of reconfiguring our basket of stocks and starting a new fiscal year. So just wanted to quickly first take a look at our decision to purchase Medical Properties Trust back in August of 2021 over Welltower, which is also a real estate company invested primarily in hospitals. And as you can see here, Welltower is at the top, Medical Properties Trust is at the bottom. And so Medical Properties Trust did perform better than Welltower um, for probably about a year after we purchased them, a little less than a year after we purchased them. And then it's just been downhill from there. Um, if you don't know, Medical Properties Trust is party to a lawsuit. There's a huge short interest on this particular company. And for me, all that stuff is very interesting. So I've had a lot of fun following this particular company. And I do think it's a solid company. We'll go over just real quick what they do here in a second. So I did go back and recorded all of the monies that we brought in from Medical Properties Trust. Now, the larger amounts you'll see here are going to be dividends. And then some of the smaller amounts, like this $13.35, are options. Okay. And so that is our investment strategy. We sell options to purchase shares, and then we sell options to sell shares. And so in the beginning, we sold options to purchase shares. And here recently, we've been selling options to sell shares, and we've been collecting dividends along the way. All right. So what this looks like, currently we have about 14,000 invested in Medical Properties Trust, which has gave us a 19% return over the last 3 years, which comes out to about 6% a year. So not at all upset about that number. That beats inflation, and that's primarily what this is about for me. All right, let's take a quick look at what Medical Properties Trust does and where they are. They own a bunch of different hospitals throughout Europe, Australia, and the United States. And you can kind of see those there. And then this is what the mix looks like. They are, I believe, still the largest um, hospital property in the United States. And so a large part of why I'm excited about this company is because when you talk about something recession proof, um, that's that's a hospital, right? And so over the last few years, Medical Properties Trust has been hit with some really damaging things to this business. And so I also went out and looked at a comparison of some other companies to kind of see where Medical Properties Trust stands. So first things first, they were hit with COVID. Okay, now what happened during COVID is that hospitals were overwhelmed. But because hospitals are also mostly nonprofit, there's definitely some for-profit hospitals in there, but even those um, pretty much have an agreement that if you show up and you are dying, they will at the very least stabilize you and then send you to a different hospital. What that means is almost every hospital in the United States has to pretty much give free services. I have heard stories over the years of hospitals completely denying people to walk through the door, but that is very, very rare. And so during COVID, you had a lot of hospitalizations, and hospitals were trying to get paid, and some of them got paid, a lot of them did not. There was also this huge ramping up of nursing and medical professionals. They were getting paid all this big money, all this overtime, and so that really hurt hospitals. And now they're really unwinding that, and I think they will be back on stable footing again here shortly. But that was the first thing. The second thing is Medical Properties Trust is more of a bank than they are a real estate company, and that's another reason why I was really excited about these guys. So what they do is they actually purchase hospitals from the hospital in exchange for the hospital paying them rent. Okay. They also are involved in joint ventures where they will say, okay, we will extend you this particular loan, but in exchange, you have to give us 10% of your profits or something like that, right? There's also situations where Medical Properties Trust will literally just extend a loan to a hospital, and then the hospital will pay them back. And again, fairly safe, because in order for hospitals to go bankrupt, some things have to happen really, really bad. Okay, and so now the third thing is that Medical Properties Trust does have a few tenants that are for sure in some dire straits. Number one is Prospect, and number two is Stewart. Both of these hospitals are currently in negotiations with their creditors to basically pay things back. They're trying to sell off some properties to get some money and stuff like that. But keep in mind, these are hospitals. So you're talking about, some of the largest metropolitan areas in the United States where these hospitals are located. And so, California, Pennsylvania, I believe New York. And so these communities don't want to shutter these hospitals. These hospitals are needed. Most of these are going to be your general, ER type of hospital, but then there's also going to be some behavioral health, which is something that they got into a couple years ago, which I was very pessimistic about, but I understand from a humanistic perspective why they moved into that area. In Europe, it makes a lot of sense to do that. In the United States, behavioral health, it's still not like it's not as prevalent as we like it to be. There are still horror stories about what has happened at some of the psychiatric hospitals in the past, and that kind of thing still persists in the culture. And so either way, but I get it though, because those centers are necessary and they're so important to society. And so anyway, so those hospitals, even though they are in some financial straits, even though they are having some problems, the idea that they just completely go away and there's no one there to take them over is not going to happen. It can, but like I say, a lot of things have to go wrong for that to happen. And that's where Medical Properties Trust has the advantage, because remember, they're purchasing these hospitals, so they own the hospitals. And so even if you do have like a Stewart or a Prospect that, for whatever reason goes out of business, someone is going to come by and take that hospital, right? They're going to either purchase it from Medical Properties Trust, or they're going to enter into a new agreement with Medical Properties Trust to lease or rent the building. So anyway, that's kind of where they stand. I want to take a look at what we chose as our comparison. Okay, so number one is Omega, which they do have this triple net lease structure, which is again purchasing the hospital and then renting or leasing it back to the operator. LTC, same thing. sale leasebacks where they purchase and they do all this financing and blah blah blah. And then we have Sabra. Now Sabra is considered to be a peer of Medical Properties Trust, but they are completely different in that they own the medical hospitals, but they don't do any sort of financing um, or leasing things back. They do go into some investments, but it's just not the same thing. Okay, it's not the same thing, but it's close. And so that's what we're going to kind of look at here in the numbers. First things first, wanted to quickly look at um, where Medical Properties Trust is uh, right now. This is as of June 30, 2024. Okay. And let me get rid of this stuff for now. All right. Um, Now, first things first, one thing that Medical Properties Trust did that I'm not happy with is that they included their um, intangible lease assets in the number with land and building. Okay. In the past, they have separated out land and buildings, which that's what you're supposed to do, right? And then at some point, they decided to include land with the buildings. The reason why that's important is because the price of land can appreciate, but for the most part, it remains the same. Buildings, however, do degrade over time, and so the value of those buildings do decrease, and so that is usually shown in the financials, right? But now this year, something that they've done that I do not appreciate is that now they have included the intangible lease assets, along with the land and building. And what those intangible lease assets are literally the value of the agreement that they have with the operator. And this value is completely made up. Okay, there are some rules and guidelines about how you go about evaluating those things, but again, they're completely made up. The most recent famous story is the Trump properties, right, where they valued them at such a high dollar because of the intangibles, right? The building may only be worth $100, but because it was owned by Trump, then you can sell it for $300, right? So that extra 200 is the intangible asset. And while it is true, like intangible assets are real, right? As far as their value, the number is completely made up, and you can argue all day long about what that number is. And so I always take the intangibles out of the number. Unfortunately, this year, for the first time, um, they don't break out what the value of the intangibles are. And so what I did was I literally just assumed, okay, that the building assets have not changed. I didn't have any other way to do it, unfortunately. So um, it is what it is. I have no clue what the actual number is um, because they didn't break it out. But I did take out what I thought was the intangible asset because I don't want to include that in my valuation too. All right. Construction and process, there is none. Investments, again, these are going to be all their joint ventures, all of their financial dealings that they have with these particular operators. As you can see, this number has basically gone down in the last couple years. And keep in mind, everything that you see that's been colored like this is an estimation because this is as of June 30, 2024. And so what I'm doing here is I'm saying that this number can change, right? But this is what it is as of today. But by December 2024, it can be completely different. These numbers that are not shaded, those are the actual numbers from those years. So this is the actual number as of the end of 2023. Okay. And so as of right now, that number has fallen off quite a bit over last year, and we'll go into that here in a moment. All right, loans. Again, these are loans that the company it has made to these operators, and so that is an asset because they're going to be receiving their money back plus interest usually. As you can see, the number has jumped up quite a bit, but and over the years, it's been up and down. Right? It's been up and down. And so cash is up pretty big because they have been selling properties, just trying to get some cash to make things better. And so whether or not that number stays there by year ends, we don't know because usually they are using cash to pay down debt. We'll get into that here in a moment as well. And as you can see, over the years, that number has also kind of been up and down as well. All right, receivables. This is going to be rent receivable. So whenever they sign a lease, let's say they sign a lease for $100, but the person has not paid that lease yet, that $100 is receivable. Okay, and so as you can see, again, that number has been pretty up and down. It had dropped quite a bit last year, and so I imagine that it's going to be the same, or it's going to drop off again this year, just because they have not been actually receiving rent from a few of the larger tenants here. All right, and this is other assets. The other assets is just restricted cash. So it's literally cash that they have, but they can't touch it because the cash is supposed to be used for other things. And then what I've did here is I've simply used a bit of statistics to try and come up with what we think the number can be a year from now. Because remember, when we invest, we're investing looking towards the future. So what are these numbers going to be, like I said, a year from now? I don't want to try to go out much further than that. And so the way I'm doing this is I'm just using a standard deviation as well as a simple average, not getting too fancy about it. And we're using 3 years worth of data basically. And so as you can see, over the last 3 years, this number has increased on average about 21%, and it's fluctuated up and down about 1,700. And so the question now is, what number do we put this at? So if it was at 59.36. And we know that on average, it goes up and down about 20%. Our options here from 46.15, our options are 71, 46, 76, and 41. And so 76 and 71 is too far. It's almost 50% increase, right? 41 is actually less than what it is now. So I'm going to go with the 46. That's the closest thing we have available here. All right. And so that's what I did down the line here. To try and predict where we think the number can go over the next year. All right. And then based on this number, that tells us what we think the price will be or where it can go. Okay. All right. The debt. The debt, as you can see, has slowly increased over the last couple of years, but that is changing. That is something that the CEO has said over and over again, that they are working to reduce the debt. And you can see over the last couple of years, it has fallen quite a bit. 2020 was really a breakout year for this company, and we'll see why here when we start comparing companies. But that's thrown the average off, right? So it's still at an average of 5%. But as we know, they have definitely been reducing debt. And so right now, sitting at 93, I have a small increase of 5% just because that's kind of what the numbers say. But it can definitely go down from there. All right. Account payables, that's basically just going to be like, rent on the corporate office buildings and payroll. Right. That thing has slowly increased 2%. But as we can see, it's really kind of gone up and down over the years. All right, and then deferred payments. This is revenue that they cannot use, basically. So it means that they have the money, but they have to use that money to pay for whether it be like maintenance on the building. And that's one of the other cool things about the way some of these leases work, where they own the hospital, but they're not responsible for any of the maintenance. And so what'll happen is Medical Properties Trust will charge the hospital operator for the maintenance, and then Medical Properties Trust will, in some cases, actually perform the maintenance. All right. And then this is all of the lease obligations. And again, this is just more contractual agreements that they have with these hospital operators. As you can see, it's slowly increased 3%. And this is important to note. When you look at the average increase or decrease on the liability side, this is money that they owe. It has slowly increased. Okay. But then you look at the asset side, and we see that the assets have slowly increased, with the exception of cash, which makes a lot of sense. All right. Usually, as liabilities go up, cash goes down. Right. But the assets have increased. Now, whether or not that is part of some financial finagling or whether it's or good management, will be seen. I think it is good management. I really do. Like I said, it's a really good run company. The CEO has been around from the beginning. He said over and over again, this is his baby. And so that looks really good to me. You know, when you have liabilities increasing by single digits, but assets increasing by double digits. And so anyway, so what we do is we net these out. We just take assets minus liabilities and see what's left over. That's something that we all understand, right? If your assets are more than your liabilities, that is a huge problem. That's not a business I want to invest in, right? So on average, this balance sheet has increased by 5%. I'm happy with that. Okay, so now that we have that out the way, now we can start getting into some math. Okay, now the share count. These are the stock shares that the company sells to shareholders and investors for a piece of the company. All right, and so in the past, Medical Properties Trust has increased the number of shares every year to not only pull in extra capital and extra cash, right? But also to pay out their executives, because that's another important piece of this that I actually did not pull up, but I may do here in a moment, which is what are the executives doing? Are the executives selling their shares because they think that the price is going to drop, or are they purchasing shares because they think the price is going to increase? Remember, for a lot of these guys, the shares are a large part of their pay. And so that's what Medical Properties Trust has been doing. As you can see, they have not been real crazy about increasing the number of shares, which is good, because what you don't want is shareholder dilution, where they just bring in more and more and more cash, selling more and more shares, but then not doing anything with cash, right? And so we see that they've been really good about this. Again, to me, that points to good management. All right. So based on the number of shares, what we do is we simply divide that by the net balance of the balance sheet. Okay. So again, you have assets minus liability. Okay. And divide that by the number of shares. It's as simple as if you have $100 of cash, but you have a bill for $50. Right? That means you have $50 left over, but you have 5 people in your family. So each person gets $10 a piece, right? And so that's what this number indicates here, right? The book value, right? The book value per share is $13.53. Now, what's important to note here, the share price is currently not $13.53. If this was a perfect world, that's exactly what the share price will be, but that's not what's going on. And the reason why is because stock price is predicated on future predictions. Okay, so right now, as of August 10th, the share price is $4.66. Now, if the share price is $4.66, what that means is that currently the I'm supposed to change this. No matter how much preparation I do, there's always something. There we go. Okay. All right. So what that means is the price to book value is 0.34. It means that the actual share price is only 34% of the actual book value. The only reason why this happens is because investors and shareholders think that the book value is not actually $13.53, meaning that they think that either the liabilities are way higher than what they're reporting or that the assets are way lower than what they're reporting. That's the only way that that works. Okay. For the most part, most companies trade at about one one price to book, right? Meaning that the price of the stock is 100% of the actual book value. Anytime that the number falls below that, it means that either this company is really, really cheap and you should definitely buy it, or it means that there's something going on that someone else knows that you don't know. Okay. Now, remember I talked about the short interest on this particular company. There is an investment hedge fund that profits on shorting companies, right? They find a company to short and they short the hell out of it. And I'll tell you right away, Medical Properties Trust, based on the three things I told you at the beginning of the video, is exactly the kind of company that you want to short because, oh, I forgot. There's one other thing that is bad for Medical Properties Trust because of the type of business that they're in, where they go out and they actually borrow money to buy hospitals to then turn a profit on the rent or the lease, means that interest rates are they're sensitive to interest rates. So when interest rates go up, typically these kind of companies do poorly, right? Because they have to spend so much more on the getting the loan, and it's hard to turn around and then construct a lease or rent that will cover the interest rate on the loan. Okay, especially if you make a contract to lease a hospital in 2020 where the interest rates were like, let's just say 4%, right? Now that lease may be for 5 years. Who knows, right? But it within that 5 years, all of a sudden, the interest rates are now like, 6%, 7%. Well, that means that you're spending more to go out and get a loan to cover the purchase of the hospital, but the lease does not reflect the increase in interest rate. Now, a lot of their leases and stuff like that do have um, uh, riders in the lease that say, hey, if interest rates go up, then you have to give us more money, right? But again, that's something that's also hurting hospitals currently. So again, price to book is 0.34. That's really low. But what's important here is not necessarily looking at just the price to book, but looking at the history of where the price to book has been, because that's what we need to really understand. Okay. So again, all the shaded areas are predictions. Okay. So for 2024, predicting based on the numbers that the price to book is going to be anywhere between 0.22 to zero point 0.5, meaning that in 2024, we do not expect the price to book to ever reach one. Okay. In 2023, the price to book did reach one, but it also got down as low as 0.32. So that means that we're really kind of in line with what it has done historically. In 2022, it got down to 0.76, but it got as high as 1.84. In 2021, it got down to 1.51, got as high as 1.89, which again isn't far off 2022. And then in 2020, it got down to 1. but got as high as 199. Again, 2020 was a really breakout year for Medical Properties Trust because after 2020, we have COVID and then everything goes downhill from there. If I went and pulled numbers from 19 and 18 and 17, which I have done for this company, they look completely different and it throws all of the numbers off because we're talking about literally like two different times in history. It would be like trying to compare uh, J.C. Penney's to 1940 to J.C. Penney's today. Like they're two different companies, even though it's the same company. You know what I mean? So anyway, again, 2020, we can see Medical Properties Trust is kind of at the height of where they're going to be in the last couple of years. And so, price to book of 1 is like that's perfect, right? 2021 was kind of coming down off that high, but still there, right? And then we see just a drop off. And so, currently, again, 0.34. Does that mean we can go lower? We can definitely go lower. But right now we're kind of right in the middle of where we're predicting the price to be. Okay. All right. Now this number is the percentage of price to book. It's simply saying um, basically what is the how far off is the stock price from the actual book value. Okay, and we can see that the stock price is 300% less than book value right now, which is a huge number. All right, now this number is a projected price, and this is again over the next year. Okay, and this is based on historical data. We're talking about the last 3 years of numbers, right? So at the very least, the price $3.02. Can't see it falling much further than that. Okay, over the next year. $7.69 is based on an average of the last 3 or 4 years. And then $14.31 is right in the middle of where we have been over the last 4 years. And then 26.87 is the absolute top. Okay, now keep in mind in August of 2021, we purchased this company at a price at about $20, I believe, $19. And so 26.87 again demonstrates the top. Like it can't go any higher than that. Any number higher than that would be kind of ridiculous. So that's the range, anywhere from $3 to $26.87. And the question that we're answering today is, can we get the stock price back to where we are profitable? Okay, and so for us, that's going to be somewhere around the $10 range. And as we can see, it is possible, but it's going to take a while to get there. All right. Now this is the revenue. Our profit loss statement. And again, shaded areas are predictions. Again, this is based on June 2024 here. And then the highlighted yellow is our prediction for basically 2025. Okay. So as we can see, revenues have been, kind of up and down, definitely dropped off in 2023 and showing a possible increase in 2024. But honestly, I don't know. The companies that are having a problem, they are restructuring. I know that Stewart has started to pay pay rent again. Prospect, I believe, started paying rent again in September, but um, you know, I don't know if it'll get there, but that's what the statistics say. All right, interest again. This is all about the interest rate, right? And so we can see that it has fallen off for the most part every year over the last couple years, and a large reason for this is because they are receiving interest, but they're also paying interest, and so this number is literally going to be a combination of those things, and so they've been doing pretty good in that department. All right, building again, they don't spend a lot on building maintenance, but they do spend some. Okay, and so that's what this number represents. represents. Again, as you can see, kind of up and down, but for the most part, has fallen quite a bit. Payroll has increased over the last couple of years. I expect that to continue. Sales. This is a big one because we know that they are in the process of selling some of these properties in order to get some cash, and so we expect that to continue. And so that's why this highlighted number is still pretty high. It's actually exactly what we think it'll be in 2024. Okay, impairment. This is the big one. Now, impairment is not a cash expense. Okay, it is a book expense, meaning that it's an accounting thing, right? And it is if you have a hospital that you valued at $1 million, and now you say, oh yeah, you know what? I think it's only valued at 500,000. Well, that 500,000 difference is an impairment, and that actually goes to the profit loss statement for this particular type of company. And so that's what we see here. And they have a lot of impairments over the last specifically year or two due to the problems that they're having with some of their tenants. And it's not just the value of the property; it's also the value of the contracts and negotiations and agreements that they have with these companies. So if they loan somebody $1 million and they're supposed to pay them back $1 million plus interest, well, you know, if they're renegotiating that loan, well, now all of a sudden maybe that loan is not worth $1 million plus interest. Maybe it's worth $1 million plus half the interest, or maybe even it's worth $1 million with no interest, right? And so that is also going to be part of impairment. The question becomes, how low can that go? That's the big deal, because right now it's really high. It's the highest that it has been in history for this company. So we don't know if we've bottomed out as far as that's concerned. But again, the important thing to note is this is not literal cash leaving the company. This is just an accounting thing, but it does affect the profit loss statement. So when they report their numbers for the quarter and for the year, this number does say basically net profit is zero or negative because of this impairment. All right, equity. Again, this is going to be all the investments and agreements that they have with the companies, whereas they loan the company money for an exchange of 10% or whatever of the company's profits. And so when those deals and those negotiations change and the values are not as valuable as they once were, this is also going to be affected. As you can see, over the last couple of years, the equity investments have been really good for Medical Properties Trust. I mean, this is their business. This is what they do, right? You see nothing but positive numbers. It's only been in 2024 that this has been a huge negative number. And so the question becomes, well, next year, where's that number going to be? And so I don't think it's going to be negative. I think it's going to be barely positive. But I don't think it's going to be as negative as it was, because, again, the game plan is hopefully this quarter, this year is the bottom as far as throwing all these numbers out. Investments, same thing. Investments in equity, pretty much the same thing, but different, just because the equity is actually ownership in these companies, whereas investments, let's see if I can get to some. Investments are things like interest rate swaps that they use to make their interest less, right? So if they have a loan at, let's just say, 5% interest, what they may do is they may invest in a security that increases anytime the interest rate goes up. And so what that means is their interest rate on their 5% loan may now move to 6%, but they're also making money over here on this investment because the interest rate moves to 6%. And so, again, those investments, horrible for the last 2 years. But as you can see, again, it's been decent over the last couple of years. We see a fall in 2020, but over the last couple of years, the number has been pretty good, and so we think that's going to continue. Taxes, because this is a REIT, they don't pay a lot of taxes, but the taxes they do pay has to do with property sales, and so we expect that to continue because we expect them to sell more properties. All right, and then foreign currency exchange. Again, this is all about management. All about management because they have properties in other countries, Colombia, Netherlands, Australia. Um, they're receiving currency, different currencies, right? But they have to report everything in U.S. dollars. And so what happens is if, let's say, the Australian dollar goes down in value, then that means that when they report their earnings in U.S. dollars, they have to show that they lost some money on that Australian dollar. Same thing goes for the Colombian peso, so forth. They do have some investments, again, that they use to try and offset that. And when it's going good, it's going good. When it's going bad, it's bad, right? So as you can see here in 2023, going back to 2020, they've always had a positive net return, even with the impairment there. In 2024, we're expecting them to finish the year in a negative. And the only way that changes is if we get rid of the impairment. So that's what I'm going to do here, just to show you what that looks like. If we get rid of the impairment, then all of a sudden, then all of a sudden, we're still, wait a minute, make sure I did that right. 14.8. There's always something. Okay, so this is without impairment. Sorry. So even if you take out the impairment, still not expecting a positive uh, profit in 2024. A year from now, though, I think that can definitely change. Now, same thing, doing some math here with the numbers. Earnings per share is literally net profit divided by the number of shares. Because if you make $100, but you divide it by 10 people, each person gets $10, right? So in a perfect world, the stock price ought to increase by the earnings per share, but that does not always happen. Matter of fact, usually the stock price increases by more than earnings per share because when you're investing in a company, you're investing for the future. So you're not just looking at the earnings per share this year, but you're also looking at a percentage of the earnings per share for the next, 2 or 3 years, right? And that's where we get the PE value from. And again, change this formula. All right. So the PE, which is price to earning, okay, it just looks at the actual stock price um, based on where the earnings per share is, right? The more positive outlook an investor or shareholder has for the company, the higher the PE, the lower the optimism and prospects are for the company, the lower the PE, right? And so again, it can mean one or two things. It means either the company is really cheap and you have a low PE and you should definitely buy now, or it means that someone knows something you don't know and you ought to stay away from, right? Same thing goes when the PE is really high, it means that either this is really great company that you ought to buy, right? Because everyone else thinks it is, or it's a company that is way too expensive that you ought to stay away from. And so that's the exciting thing about investing. And again, we have percentage of PE for price, and again, I have to change the formula here. And it is just how much of the earnings per share are part of the price. And as we can see here, it's only 35%. Now, the projected price based on the profit loss statement is here, and it kind of mirrors the price to book on the balance sheet, actually. $1.93 is the lowest, 729 is the average, 1547 is right in the middle, and the 2960 is the absolute highest. The other thing important to note here is the dividend. Now, they have recently come out and said that they are going to decrease the dividend to only 8 cents per share, where it was 15 cents per share, which also was like a crazy high yield. I think it was maybe 12% or something like that. So they're bringing the dividend down to where it's now going to be about 5%, which is still high for a stock. It's about average for a REIT, honestly. But what that means is that they're going to have a lot more cash on hand that they don't have to pay out into a dividend. So not unhappy about that at all. As long as they have not missed a dividend payment or they're not suspending the dividend, we can definitely stay in this company. If that does happen, though, then we have to get out. We have to get out. Okay. So again, looking at what the price is now and looking at where it can be, again, we're kind of right in the center. What I want to take a look at, though, is what has to happen for the price to go back to us being profitable. And I'm going to use the um, I'm going to use the balance sheet for this because I think the balance sheet these numbers really affect the price more than the profit and loss does. And we'll see why that's true here in a second when we look at comparisons. All right, so in order to get to the 7 to 14, that means that the price to book has to be at least 0.5. If everything stays the same as far as assets and liabilities, okay? Price to book has to get to at least 0.5, which is expected to do in 2024. Whether or not that happens is yet to be seen. But well, actually, I'm sorry. No, it has been seen. Sorry, 0.5. So I definitely think it can get there again. 2023 was not a great year, but price of the book got all the way to 1. So based on the information alone, I think we hang on here. Definitely going to continue to monitor this. If anything changes, definitely going to make note of that and make a decision. The biggest thing for me, honestly, is the impairment. Okay, that one, as well as the invest and the equity number, is something that definitely want to keep a look at. But I really do think that we have a good shot at getting this price to book back up to that 0.5 number, and that'll put us back in the area of profitability. All right, actually, a little higher than 0.5. Yeah, a little higher than 0.5 will put us back in profitability, but I do think it's possible. I really do. Okay, now let's take a look at some of the comparisons. Now, um, this is something that I saw that I really thought was telling. And remember again, the reason for looking at this is because I wanted to see exactly the net or the share. Okay, yes, the net. All right. I wanted to see how the other companies that were doing the same type of business were faring um, with um, with this new environment that we're in for hospitals. Okay, so right away we see again that the net balance sheet for MPW has increased slightly, 5% over the last couple of years. You can see 16% in 2020, and then two fell a bit in 2023, and expected to increase a bit in 2024. Maybe it falls a little just based on 2023, but um, it's yet to be seen. It's yet to be seen. But either way, like I said, on average, 5% increase, right? Come over here and look at Omega, and we see that over the last few years is actually falling on average 30%. And we could see in 2020, maybe that's not a good number to look at because it's such an outlier, but -7, up 9, and then unchanged between 24 and 23. And so what that tells me, just looking at this, is you know, from 24 to 23, it's you know, all these guys are not doing great, right? Better in 23 to 2022, but then as you can see, 2020 through 2022, not so great, right? All right. LTC is another company. Forget what is it? Long-term care, maybe, I think is the name. Doesn't say. Oh, because it's not. It's just LTC property. Okay. Anyway, but I think it is. I think it does stand for long-term care. Anyway, on average, -1, right? Again, as you can see, 24 to 23, a fairly large drop. Big decrease in 2020, whereas medical property trust had a huge increase, right? A nice increase 22 to 21, and then a small increase 23 to 22, which is good. And then again, we see this drop. Now, this 1% does not include this 24 to 23 because that's a predicted number there. So this -1% is basically coming from this 19% here. So 10 to 5 is still a decent increase, but again, uh, you know, probably going to drop off a bit here, 24 to 23. And then Sabra, SBRA, which again is not necessarily direct peer of Medical Properties Trust, but they're in the similar industry for hospitals either way. So you can kind of see what's going on with their business as well. Again, on average, dropped 2%. You can see there was a small increase from 2020, but then there should be been a steady decline from 21 all the way to 24. And so again, what that tells me is that it's not just medical property trust. All these guys are having problems. It's all the hospitals. I didn't go out and grab like just straight up hospitals to see what their numbers are. Because I kind of already know the story, and again, it's not even close to being the same business as being someone who finances and rents to hospitals, right? So again, the point is, all these guys in this particular industry are having some trouble. Medical Properties Trust is definitely um, one of them. All right, the next thing I want to take a look at, just again in comparison, is the price to book. Okay, now again, Sabra, not a direct peer, but definitely similar. Their price to book is just right under 1. Okay, which is good. That's about where you expect the company to be. LTC price to book 1.21. which means that they're doing pretty good. The other thing to note here, let me back up just a second. If you look at the price on Sabra, it's 35.91. Okay, and then this is the potential price for Sabra predicted. Okay, 15 at the low end, 39.46, and then 150 at the high end. Okay, 35.91 is where they are currently, and so that puts them, kind of in between there, right? If we take a look at the balance sheet, as you can see, 35.91, they're way over, way over, and that's how you get this. I don't even know honestly this price to book of 9.3. Matter of fact, let me go and change that again. There we go. There we go. Well, close to it. No, it's actually much different. Yeah. So price to book of 2. So it's almost double, right? Almost double the price to book. And I think that says a lot about, again, different kind of company, right? Because this price seems to be much more in line with the profit loss than it does the balance sheet. Okay, it's not even anywhere in here, the price for the balance sheet. So that tells me that this particular company probably follows the profit loss more than it does the balance sheet. Okay, LTC. And I got to change the formula here. There we go. LTC, again, price to book 1.21, which is really good. Price is at 36.74, which look at this profit loss. The price is nowhere near what the profit loss is. It is way down, right? But we come up here to the balance sheet, and all of a sudden, the price falls right in between these numbers. So that tells me that this particular company trades much more based on balance sheet than it does profit loss. All right, now let's take a look at Omega. And again, these are direct competitors and peers of Medical Property Trust. All right, current price 38.05, and it is in the realm of this profit loss, but like this 1,100, that's a crazy number. There's no way that the stock price goes from 38 to 1,000 like anytime in the next decade. If we look at the balance sheet though, where'd it go? If we look at the balance sheet though, again, $38 puts it above. Let me change this. Give us a little better. And it's just an updated price. All right. Yeah, price to book 1.79. Again, really good. That means that obviously investors and shareholders are really excited about this company and think they're going to do really great things. Again, price is 38.05, and it is still over the balance sheet, but close, right? It's not like a crazy number. But again, you come down here to the profit loss, and even though it is in there, right, it's these numbers are just crazy. So again, it tells me that this company trades much more closer to the balance sheet than it does profit loss. And the same thing goes for Medical Property Trust. And so again, just confirming that when we take a look at where we think this company can go, it's much more in line with the balance sheet than it is the profit loss statement. And I think that has a lot to do with the fact that there are a lot of things on the profit loss sheet for these particular companies that don't really reflect what's going on with the business. Because even with the investments and the equity side of this thing, again, these are valuations, right? They're not actual they're not actual cash losses. You know, when you reevaluate the value of an agreement you have with a company. So again, I'm going to give you $1 million in exchange. You're going to give me 10% of your company, right? Well, until I sell that 10% of the company, I haven't lost any money, right? I still own the equity, but I have to revalue it, right? I can't say that this agreement, this investment is still worth $1 million if the company is losing money, right? Obviously, the value of those equity shares has gone down, and so you have to reflect that on the profit loss statement, and that's why specifically for these companies, the cash flow statement is a much better tool to use to understand what's really going on with the business. And in this case, again, we're looking more at the uh, balance sheet than anything. As far as I'm concerned, as long as they have the cash to cover the dividend, I'm happy, you know. Um, and they're covering their loans. They're not paying uh, their providers and stuff like that. So they're good. And that's what this number here is, right? So literally 20% of the net profit predicted in 2025 is there to cover the dividend. So they have more than enough profit to do that. Coming back over to historical numbers, right? So this is based on the current dividend of 60 cents. Again, if they are a negative on net profit, largely because of the investment in the equities, which I'm not even going to get into the math of figuring that out. Then of course they won't have it, but they will, because again, the equity and investment are not cash losses. In 2023, it was right at about 100%, which is not great. But again, they paid all their dividends, no problems, no issues. In 2022, it was about 50%, 2021, 65, 2020, 80%. So again, we only invest in companies that have paid a consistent dividend for 10 years. And if they miss a dividend payment or they stop paying dividends, we no longer invest in that company. So again, the point 0.5 um, point 0.5 price to book is achievable. It doesn't quite get us to where we need to be, um, but um, but I do think that we are safe where we are until something changes. Um, we're going to stay here. The other thing important to note is, again, it's a high short interest. So what that means is, if something were to happen, and this did happen maybe a couple months ago, where there was some good news that came out about Medical Properties Trust, and so the stock price starts going up, right? Well, all those people who are short the stock lose money when the price goes up, and the only way they can stop losing money is to buy the stock, right? Because you can buy and then sell, or you can sell and then buy. Okay. And when you buy a stock, the price goes up. When you sell the stock, the price goes down. So they shorted the stock, which brings the price down, right? But if something good happens and that stock price starts going up, they're going to lose a lot of money unless they buy the stock. But when they buy the stock, that pushes the stock price up even further. And right now, the short interest is something like, I think, 30%, something crazy like that. And so there is a good chance that what we may experience here is a short squeeze. And what that simply means is that you go from having a 30% short interest to like 5% short interest in a quick amount of time, because the more short sellers that buy to close their positions, the more short sellers you're going to have buying to close their positions. And it's just an effect. And then what happens is you have other traders that are looking at, oh my God, Medical Property Trust is up like 5-6% today, and then they're going to start buying just on momentum, and it goes crazy. And so looking forward to that. There's also again the lawsuit that's at play. Who knows where that's going to go? But so far it looks good. And the lawsuit is specifically concerning this hedge fund that again they profit on shorting companies. And part of the problem is that if they use false information to make a report, and then that report causes people to sell shares in the company, that company can then sue, right? And so that's what they're trying to do now, is they're trying to prove that this company put out false information about Medical Properties Trust, specifically about how they run their business in order to cause people to sell the shares. And if they win that particular court case, the cash value that they receive from the lawsuit does not matter. The important thing is that there's going to be a news story that says, hey, you know that report they put out saying that you ought to definitely sell Medical Properties Trust, you ought to definitely short Medical Properties Trust. Well, guess what? That was actually false information, and I think that's going to have a huge effect, primarily on the short squeeze. Not only that, I think the interest rates, the Fed definitely wanted to break something, and I don't think it has broke yet, but it is getting there. I mean, people are complaining a lot about inflation. We've heard of stories of layoffs in some of these high white collar sectors. They're always first, right? It's not until those layoffs start affecting blue collar workers that we start to have some real panic and some real action by the Fed. So I don't think we're quite there yet, but we are getting there, no question about it. And when those interest rates start to come down, companies like Medical Properties Trust are going to benefit from that, because again, they'll be able to get loans at cheap interest rates, and then they'll be able to make that money back plus a whole lot more on rent and lease. All right. From me to you, I holla.